Well, the market cycle seems to be speeding up because one of the classic effects heading into major market events like a US Federal Reserve interest rate decision is that we sometimes see a buy the rumor, sell the fact effect. In other words, because good news is expected, in this case, the lowering of US interest rates, share market investors have dived in ahead of that event and pushed the market higher. Now, we sometimes see the market get to that point in time. The event comes out just as expected. In other words, rates will be cut by 25 basis points on Thursday, and yet the share market falls rather than rises. And the reason is very straightforward. Everybody who's wanted to buy has bought ahead of the announcement. And once the announcement arrives, there's no one left to buy. And of course, in the absence of buyers, markets fall. Now, last night, we saw US markets come under pressure, even though we're still 3 days away from that US Federal Reserve decision. It does look like there are some getting concerned about the potential market impacts. The fact that, it's almost a fact that there will be a rate cut on Thursday morning, our time here in Australia. But how the market reacts is now less certain, particularly with the falls we saw last night. So the S&P 500 was down just over 1/3%, but negative sentiment had run around the world before that. And in fact, we'd seen real pressure in the Asia Pacific session, with Hong Kong down more than 1.2% in trading yesterday. So that negative sentiment is a global rather than a US phenomenon, but nonetheless, it was evident around the globe. We also saw pressure on crude oil markets. And while a lot of analysts this morning are talking about threatened increases in Iraqi production, this could also be a product of that same swing in sentiment about the outlook for markets in the short terms. So locally, we've got Australian investors very concerned about what might be said this afternoon when the RBA delivers its interest rate decision and the governor speaks. And although it's almost certain there'll be no change to Australian interest rates today, what the governor says is going to be very important. We'll come back to that point in a moment, because we've got concerns all around the globe. At the moment in Hong Kong, there is caution ahead of the annual policy meeting that will be coming up and set the tone for 2026. And what policymakers decide there could have a very big impact on the performance of the Hong Kong share market. And in the US, of course, we've got investor uncertainty about the path for interest rates over the course of 2026. Now, once again, it's almost certain we'll see a rate cut this week in the US, but what happens next year is very important, with some analysts pricing in 3 further rate cuts in the US and others pricing none. There's a huge divergence in expectations around this event this week. And so the focus will likely be not only the comments from the chair, Jerome Powell, but also the dot plot. Now, this dot plot is regularly talked about. It's the plot of all of the governor's expectations for interest rates over the next 3 years, and where those dots land, where the 12 voting governors on the Federal Open Market Committee vote, where they estimate interest rates will be over the next 3 years, could be very influential over share markets in the near term. So something to look out for, and an area of focus for investors and traders. Of course, a higher cash rate here in Australia could set us apart from the rest of the globe. We've spoken for the last 12 months about how central banks are now marching to their own beat and looking at their own economies rather than the global outlook in setting monetary policy. And that focus means we could have a period where Australia is lifting interest rates and the US is cutting interest rates. Now, just as we know in share markets, the surest predictor of share price movement is earnings revision. When it comes to currency markets, one of the surest predictors is interest rate differentials, and particularly in outlook. So if the outlook becomes, after we hear from the RBA today, that Aussie interest rates are on the rise, while at the same time US interest rates are falling, the impact on the Australian dollar is likely to be both profound and long-lasting. Now, this is important because if the RBA does talk a tough game this afternoon, it looks like interest rates are heading up at the next move in Australia, and the share market falls, that might only be a temporary reaction, because that change in interest rate policy, could see the Australian dollar firming and potentially heading significantly higher over the coming months. And if that's the case, it's going to get the attention of international investors, both retail and institutional, because a positive outlook for the currency makes Australian investments look a lot stronger. If you're going to get a currency kicker of 10 or 20% on top of the return you get by investing in an Australian portfolio of shares, that is a very important outlook for international investment. And so we could, as I say, if we hit a lot of tough talk from the RBA, we could see a fall in the share market this afternoon. But the long-term prospects for Australian shares would be improved by a tightening stance from the RBA, because it will catch the attention of international investors. An effect to look out for, particularly if we get a knee-jerk sell down in Australian shares. The rate hike obviously could hit interest rate sensitive sectors initially. We're talking about infrastructure stocks, property stocks, and those who have high levels of borrowing. And that will be the criteria. The thing for investors to look out for in a rising interest rate environment is high levels of debt. Well, in fact, they should be looking for the opposite. Clean balance sheets, low levels of borrowing, low exposure to those rates going higher could mean that companies with strong free cash flow are in a position to take advantage of any distress caused by those higher rates. So something to look out for across individual companies rather than sectors. Having said that, there is one sector who profits when rates are going up, but they also profit when rates are going down, and that is the banking sector. Those big traditional businesses are where we see the bottom line driven by what's called the jaws, the interest rate margin that allows them to make profit in the market, is all important. And when interest rates are moving, whether they're going up or down, there are often opportunities for banks, whether they're using lags or whether they simply increase their margin, to improve the bottom line. So a moving interest rate environment is good for the banks. It doesn't matter if they're going up or down. Turning to our watch list today, we have 3 stocks to talk about. Now, the one that really caught the eye yesterday here in Australia was Liontown. And this is a very popularly traded lithium exposure. It was upgraded yesterday by one of the big investment houses, and it jumped 15% in trading. Now, this stock has been in recovery mode since the big sell down in April, when it touched levels just above 40 cents a share. The move that took it up to almost $1.55 is very significant, but the revision from the UBS analyst yesterday raised the target from 80 cents a share to $1.80 a share. In other words, about 20% higher than current levels. However, I suspect that if we get a move up to that level, it won't stop there, because at $1.60 for Liontown, we've got key resistance. It's the 18-month high for this stock, and a break through that level would be technically important and could see significant further gains as a breakout to a new higher trading range. So something to watch out for. It's important to note Liontown is a controversial stock. Macquarie, for example, have a sell on Liontown and are maintaining it. So it is one where investors must satisfy themselves about the prospects, as they should do with every investment. The consensus overall on Liontown is a hold rating, and I'm pretty sure the one thing that Liontown is not going to do is remain at the same price. Last night, we also heard that the temperature is going up in US streaming circles, because after the bid for Warner Brothers from Netflix last Friday, last night Paramount launched an on-market hostile takeover bid. And for anyone who's been around a while, this is a very nostalgic moment and takes us straight back to the 80s and the days of the takeovers, on-market takeovers that made legends and books were written about. So this is really starting to look interesting. There's some talk that the president thinks he can get involved here, that he might be able to allow or disallow a deal. I'm not sure what constitutional mechanism would allow that, but that's what that's what was said last night. There seems to be some uncertainty around Netflix, although its shares did fall again. Now, that's not uncommon in an acquirer. In a traditional on-market takeover, we generally see selling of the acquirer and buying of the target as the arbitrageurs move in on the basis of a deal. So Netflix falling last night is actually a sign of some confidence that Netflix could get a deal done here. But certainly the rhetoric last night was going the other way. And with a superior bid in cash terms on the table, and the fact that Paramount are prepared to take the whole deal, they've not to carve out the Discovery business as Netflix are, might make it more attractive to shareholders. But regardless, it's game on. and Warner Brothers Discovery likely to be a focus and potentially the subject of even further bids in this space before a deal is done. One to watch out for. Very likely to see significant moves in that space over the coming days and weeks. And the last one on our watch list today is IBM. Now, this old school, the granddaddy of computing, has announced a deal to buy an AI data group called Confluent. It's $11 billion deal, not a huge deal in the context of the money that we're hearing being thrown around in AI circles, but nonetheless, it's been applauded as a natural fit for IBM. IBM shares are up 40% year to date. It's pretty clear a lot of investors have rethought IBM, and they're happy to get involved. And when it's making moves like this, you can understand why some investors have confidence that IBM is dealing with the changing environment in a suitable way. This deal will boost IBM's recurring revenue. A number of analysts have a buy on IBM, and as it approaches its all-time highs, I suspect that a lot of analysts will acknowledge that this company has been transformed.